Apartment list, May 2025 National Rent Report. If that's
Totally.
all right with you, just to
Oh
give
yeah.
everyone a quick update with where we are in the housing market. We love covering these national rent reports
Yeah. This one
from Apartment List.
I've been watching this, and I think that we've probably spoken about it for the past 3 months, because this is a really I think it is a perspective that you don't see in other sources. Apartment List is a little bit more focused on the renter, not necessarily excluding the perspective of a landlord, but other places like, I would say, RealPage, and then even Colliers right now are talking about the current rent growth, which is not that great, and they're framing it as a, oh, look, we're actually doing pretty good. I'm going to give away the Colliers is spinning a 1% rent growth as strong fundamentals and strong performance. So that's 1% rent growth, where if you go back to that Globe Street article, they're talking about 2% home price growth as a sign of danger and disaster. So depending on your perspective, it's a little bit different.
Exactly. That's where I that Globe Street. We led the show with it for a reason,
Yeah, it's
because
fun.
it's fun and it stands out. And again, everyone listening to this show has watched The Big Short probably a half a dozen
Yeah.
times, and then watches clips of the same scenes, because the allure of and not even real estate investors, casual consumers,
Yeah.
anybody, people aspiring to one day to own a house, or maybe to buy another house, dream of this scenario where nothing really bad happens to them, but
Yeah.
the housing market crashes and
Yeah.
they're able to buy something for pennies on the dollar, and they make $1 billion, or shorting the subprime market, or,
Yeah.
or whatever. So there's that gets everyone excited and the wheels turning, and just like the YouTube channels that are so popular,
Yeah.
that are literally incorrectly predicting the housing market crashing every couple months. And it's like, I guess a broken clock's going to be right at some point.
Yeah.
But there's just not really the evidence that it's really happening. I mean, there's some signs here and there, but there's always chinks in the armor. The
Yeah.
economy's never perfect. But it is interesting in our industry. Rent growth is good, obviously, because that's the revenue driver for our business. Versus affecting affordability, in the pocketbooks of,
Yeah,
of
yeah.
individuals, and that's why I like Apartment List, because I think they do. They're not. I mean, they are selling products to apartment owners in terms of listing services. Apartment List obviously is an ILS like listing service to rent apartments, but their consumers are. Obviously the renters as
Yeah,
well.
yeah. I've been using this as, it really has been kind of an anchor to my perspective on rent growth. I've been like anxiously awaiting these for several months, and I said last month, like, we're gonna be waiting on May to see if we're in this real trend, which I was following. The trend being is 2024, or I'm sorry, it's 2025 rent growth weaker than last year. And it looks like, as Apartment List has measured it, this year is weaker than last year.
Yeah.
And it is not something that is on all of the headlines. Again, like, we're going to read a Colliers report that calls this strong fundamentals. Now, it's only strong fundamentals if you're kind of using the context of of the past couple of years, where it's like, all right, well, at least it's not negative. But this is not usual. This is not the pre-pandemic norm of 3 to 3.5% rent growth. This is rent growth that is also below inflation. So whatever yardstick you'd like to use, we're still working through something. And I think it also, in the same breath, you'll also hear about people that talk about the undersupply that's coming in 2026. And this is another reminder here from Apartment List that there are months before 2026, and it's not like it doesn't exist. We're not there yet.
And obviously, coming back to this theme that keeps gonna come up every single week, but regions are different, markets are different, and this is aggregating all those different regions and markets, and the Sun Belt is still wildly negative, while the Midwest and the Northeast is still is in positive territory, not growing by gangbusters. But there are markets that are seeing 6, 7, 8, 9% rent growth. I mean, we have properties in our portfolio where our average trade outs are 8%.
A very good point, and I think that much of the lackluster performance is associated with the oversupplied markets in the Sun Belt and in like the West and the mountains that we were talking about, and associated with cooling home prices as well.
And again, it comes back to this theme that we've talked about of the potential distress, and we've talked about these are the variables that will impact potential distress closer to the end of the year into 2026. And then, if rates don't come down, you have to grow out of it in terms of growing your net operating income, primarily driven by increasing rents or reducing expenses.
Yeah.
And, with property taxes, insurance all coming up, material costs have increased, payrolls increased, and now you're getting rent growth. You made the point that you hit the nail on the head. Inflation is higher than rent growth.
Yeah, yeah.
And
So-
if you break down, multifamily, the whole idea is that it's a thesis that rents outpace inflation.
Yeah.
That's the whole idea. And so if that's not happening, the model is broken in those markets temporarily. Compound that with over leverage,
Yeah.
overpaying, floating rate interest, carry costs increase dramatically.
Yeah.
It's not exactly a great recipe if you need to have something happen in the short term.
Yeah.
And so, again, we're asking ourselves, because we're about this huge price discovery in the gap between buyers and sellers, and that not enough transaction activity has taken place.
We're talking single family or multifamily?
We're talking multifamily.
Because it could be both.
It could be both. Housing. But when's the inflection point?
Yeah.
Because, unlike single family, multifamily, there were a lot of people who bought with shorter term loans, 2-3-year terms that have then been extended. Unlike a single family home, 30-year fixed rate mortgage.
Yeah.
You just sit on them for the next 20, 30 years. These loans in multifamily, so many were supposed to come due last couple of years. The bank's like, we don't want to deal with it. Rates are going to be lower next year. You're going to see some rent growth. They extended for a year or two, but now that's come due.
Yeah.
And they're saying, well, interest rates haven't come down. In fact, 10 years higher than it was last year. Those SOFR's down a little bit, but not enough to meaningfully change the equation. And, oh, by the way, your expenses up and your rents are flat or negative.
Yeah.
The math is just screams that it doesn't work.
Yeah.
And so what we would like to see for acquisitions is for there to be an inflection that forces enough inventory onto the market, there to be price discovery for cap rates to correct upwards. And I see signs of an opportunity for cap rate expansion, which means prices go down.
Yeah, and we talked about that just last week, right? Where people are still hashing out, are we at the market bottom yet? And the way that interest rates have, like, the narrative has changed, not just where they are presently, but, like, I think that in the beginning of the year, you could have maybe talked to a bank and been like, well, don't you think that interest rates are going to come down? Whereas now, you could talk, you probably wouldn't say that out loud because you'd be laughed out of the room.
Yeah, they've said it, for the past couple of years, and even though if you think that it actually might be the case, which I can make several strong arguments why they would come down in a couple ways that they could.
I think they should, but they're not.
Well, that's the thing. It's like, well, they haven't come down yet.
Yeah.
I'll believe it when I see it.
Yeah.
Are we in this, it's like time dilation or market dilation.
Yeah.
And it's going to take longer than we want or have thought it would take. And then it is what it is. You got to be prepared for it and assume that it's going to be higher. And you're baking that in. But then you do have buyers that are keeping the market up.
Yeah.
Cap rates down now because they're saying, well, I do think interest rates are going to be down. Supply is going to fall off a cliff. If interest rates come down and there's only so much inventory, that means rents are going to rise over the next several years. I don't know exactly when, but over the next several years. And at some point, interest rates will come down. So even if I look at that cap rate, interest rate spread, it's incredibly tight right now. I'm confident that rates are going to come down. Interest rates will come down, so that spread will widen again, and I'll be in an opportunity that I can sell it in that wider environment.
Yeah.
But you're having to rely more on speculation and really more of a return profile that's focused on growth rather than yield and cash flow, because you're not going to get any yield or cash flow if you're going to overpay, negatively levered. But again, coming back to the regional differences, is that, in Indianapolis, for example, it's a much tighter market because positive rent growth, less supply growth over the last couple of years. We don't have, insurance, property taxes have gone up, but not as much as some coastal markets. And so it's an easier to paint, we're not dealing with compounding negative growth. We're just growing at a slightly slower rate, but an opportunity to grow, at a much more accelerated rate once supply comes down. Those markets are seeing, there's evidence of where cap rates could hold a little bit tighter. Probably still room for some reduction because, again, I'm still seeing deals on the market that are, people want to sell them for like a 4.5 cap rate.
Yeah.
And that math just doesn't work.
Yeah.
You have to over speculate so much, and there's just not the equity there that's willing to speculate that much. They want some yield year one.
Yeah.
Relatively conservative assumptions.
Mm-hmm.
It's hard to get that aggressive when you've been fighting this last war of just slow growth. But the reality is, I think the next war, the next cycle is going to look nothing like what we've been dealing with now and recently.
Yeah.
But when are we going to move from one paradigm to the next? Is anybody's guess, and people have been burned the last couple of years trying to guess.
I mean, it looks kind of like a darkest before dawn situation if you want to, if you want to even be optimistic about it, because the raw numbers here is month over month rent growth in May was slightly lower, and U.S. rents rose 0.4%, which is actually pretty decent, but typically they grow a lot more in May than 0.4%, and if we're talking about year over year, actually, year over year rent growth is still negative. Now, slow rent growth in May caused year over year rent growth to dip further negative. This is a quote, falling to negative 0.5% after having gradually inched closer to positive territory over the prior 6 months. This marks an inflection point following 6 months in which year over year rent growth nationally had gradually ticked up from negative 8.8% to negative 0.3%. The rebound that we had been seeing has stalled out just as year-over-year growth was approaching positive territory for the first time since mid-2023. So we are talking about, is this like a last gasp? Is this a result of uncertainty and like a more direct, lower consumer sentiment?
Yeah.
So like there is, and I remember maybe it was like about a month ago, all these different readings you see as 2025 comes into view, it gets shaky. There is just like a shaky batten down the hatches kind of thing. And we talked about maybe it
God,
there.
We've been battening down the hatches for so damn long.
I know. How much more battened can they get? We're stripping the screws
Airtight.
at this point.
Yeah.
But yeah, and then they also, further down, the occupancy is actually suffering a little bit. So this is we are in a...
vacancy's peaking right now.
Yeah.
It has to, I do feel strongly that sentiment plays a major role. Maybe it's not the only thing, but because what is different between this year, May of 25 versus May of 24, because we had a significant amount, we had just as much, or if not more, supply coming online nationally at this period in 2024 as we do today. And we're seeing really still strong, apparently, demand numbers.
Yeah, job growth is, the larger economy is roughly, putting aside the tariffs, which, again, sentiment.
So that's the only thing is we've had whatever the cause of negative sentiment, tariffs, uncertainty, all of it. That's the one thing that's different, is that there was extreme uncertainty, especially in this period, basically, April and May. Whereas, look at 2019, look at all these other years. Again, obviously the pandemic was crazy, but you still typically see growth, February, March, April, May, then June, July. It's calming down as you're getting close to the start of school year, August-ish, September, whenever school starts these days. But to kind of start, basically running out of steam by like March. Is we were basically missing out.
We should have
been
peak month. Yeah, it should have been the peak month in May. If you're going by like 2019 as the exemplar for pre-pandemic, but the fact that we're going down, this is not a good trend. It is shakiness. I do think that things are coming in because we can counter this report from Apartment List with a lot of other reports. One of which is Collier's that sees the current market as having strong performance, and even Yardi Matrix has noted the resilience of the apartment market. So this,
it definitely resilient. A ton of demand. The fact that we have some positive occupancy, we're still in the middle of an incredible amount of supply, positive rent growth.
Record-breaking absorption numbers.
Record-breaking absorption numbers. So there is a lot to say, and some of that probably is being driven by some more people are renting than buying, and the fact that the for sale market is, come back to our recent point, that market has held up. There's obviously a decent amount of housing demand driven by all these demographics that we've talked about. but what is next year going to look like? When are we going to have that normal year,
Yeah.
or in any way that we make up in the back half of the year? I don't think there's enough volume of leases
Yeah.
that expire in the
You
back
know,
half of the year to make up for
I
it.
think about I think about the trouble again, like the stereotypical troubled uh, apartment borrower going in 2022 to get, or 2023, let's say, to get his loan extension, and he's like, all right, and he goes in again, and he's like, well, I just did the same thing, nothing's changed. Why am I gonna get you another extension? That's what I keep thinking of when I think of people that are looking ahead to 2026, how things are going to be better. Well, you told me things were going to be better in 2023.
And it's not going to be black and white either. You're going to get some borrowers that come
Hmm.
in, and the bank's going to be like, look, yeah, this is your third time. We've
Yeah.
talked about this. Nothing has changed. I haven't heard from you since the last time.
Yeah.
Like, you're not doing a good job. Like, sorry. This is one that we're just going to have to, maybe take a haircut. You're
Hmm.
certainly going to have to take a haircut, and we're going to have to
Did
take it
I?
over. But there are
Yeah.
several that there are some that are going to be extended again.
Yeah.
I've already heard stories anecdotally that it's like, yeah, we got another extension
Yeah.
for another 2 years, another 3 years. We got a good relationship, and it's in a really good market. We've
Hmm.
seen some rent growth, but it's still, the proceeds just don't make sense.
Yeah.
And there's a relationship involved.
Yeah. Yeah. Yeah.
So it's not going to be black and white, all the loans are due, but it could certainly be that inflection point of, again, all it takes is enough people to say, give me my money back.
Yeah, yeah. Well, and there was, I was
You're
going to
done.
say is, and this could be all office loans, but there was a headline I put in the one of the Gray Report newsletter, that things are, that banks are getting these loans off their books. That's how they're kind of relieving
Yeah.
their own pressures, is they're trying to get these CRE loans off their books.
And so, and what they're like, either they, foreclose, but either maybe just they're going to sell them at a discount, which what they're probably doing.
Yeah.
And, with whoever they are selling them to, that's what that buyer who
Yeah.
now holds the note. What are they going to do? Are they buying because they think that they're actually going to start, paying? The little payments are going to give them a higher rate of return, or are they buying it with the intent of foreclosure?
Yeah.
It will
So
be both.
that's the people that own